Hey friends, welcome to another Charts of the Week with me, Markets and Mayhem, coming to you February 20th, 2024. First, let's talk a little bit about inflation. Since the COVID crash, core CPI is up 18%, gasoline 22%, along with rent, and food is up 25%. This is just over a 4-year period, and we've been told by policymakers not to expect that things are necessarily going to get cheaper from here. Instead, we've been told that wage increases are all but making up for that difference, which essentially means, once again, we're not going to see a reset of prices back to pre-COVID levels. And if we do, it's not necessarily going to happen anytime too soon. So what does this mean? It means that this is sort of the new normal. Cumulative inflation does not get talked about enough. We talk a lot about the rate of change. That's what CPI represents. So when CPI is slowing and that rate of change is diminishing, that's called disinflation. That's not to be confused with deflation. So 2023 was, the back half was really this time of the immaculate disinflation. And unfortunately, that only means that prices are going up at a slower rate. The next chart we have here, tech fund flows. These are annualized, but if we look at the year-to-date flows and annualize them in tech, they would be record-breaking, and in fact, they'd almost be twice that of 2023 and over 4 times that of 2022. That's a little bit euphoric, don't you think? The sheer magnitude of inflows, particularly because they're going into a very concentrated part of tech. This is a little different than what we saw in 2020 or part of 2021, like the first half, where there was a broader diversified bid across a lot of the NASDAQ composite. This time it's really about 5 stocks that are really leading the way. Next, we have hedge fund long sector exposure. Wouldn't you know it, tech is at the 98th percentile, followed by healthcare, but that's quite a bit down there, wouldn't you say? So why is that important? Because again, this is a very, very, very crowded trade. So ahead of NVIDIA's earnings, however that may turn out, if the market doesn't like what it hears, we could see a pretty meaningful discounting there. And if it really likes what it hears, hey, we could still rally right on to, who knows, 800, 900, 1,000 a share. But my key takeaway here is that we are in a bit of a blow-off melt-up, because we have narrow breadth while making all-time highs, with a lot of that driven by multiple expansion at a time when the Fed has been hiking aggressively. But more than that, where a lot of the companies that are leading the way, with the exception of maybe NVIDIA, we'll find out on Wednesday, haven't really been growing with the rate of change their stock price is suggesting, which really means a lot of future speculative returns that may or may not be realized in earnings and sales, are being pulled into the present. And that happens particularly during times of euphoria. And we'll talk a little bit more about that in this Charts of the Week, because this has been a theme. Stock net call volume surging to the highest levels since late 2021. Why does that matter? Because this tells you, and this is in mega cap growth and tech, that's the MCG plus tech on top. That tells you that there really isn't a lot of concern about downside. A lot of these calls are being bought to open. They're not being sold to open. Okay, so and you can see that in the skew. The distribution of premium between puts and calls in tech heavyweights is still extremely on the bullish positioning side. Bullish positioning means people are much more positioned for upside than downside. And unfortunately, that does create some dynamics where it becomes harder and harder to realize that same upside, because as those calls lose value because of theta decay and potentially running away from some of the strikes where there's positioning, then you have dealers that are actually distributing their long share hedges, right? Because when they sell a call contract, they're hedging their delta by buying shares commensurate with the delta of the contract. So as that delta drops, as there's theta decay, as price may run away from the strikes, they can then sell those shares, which adds pressure. This is why the more call exposure there is, the more difficult it starts to become to continue grinding higher. So let's look at this in a different way. Let's look at Bank of America's allocation from fund managers into tech. This is the highest level we've seen really since early 2022, late 2021. I'm going to say late 2021, really looking at the chart here, but maybe we have to go back even further. Nevertheless, this looks kind of extended to me. They're very overweight tech. Call buying in single stock shows investors are crowded into equity upside trades. What does this show us? This is skew of S&P single stocks. This skew, by this measure from Goldman, is at the lowest since early 2021. If you were trading the market then, I remember it very well. These were days where everything got a bid. I mean, it could be the most garbage of companies that had absolutely no prospects, that was just some nonsense SPAC or something else, and these things would be up 10, 20, 30% in a day. Reminded me a lot of the late 1990s, quite frankly, the sort of stuff we were seeing back then. We're back to that level of options-driven euphoria. And that is a big concern because this is not a particularly well-hedged market. And we do have some pretty big event volatility catalysts this week. Tomorrow, we've got Fed minutes and NVIDIA earnings, both of which could move the markets quite a bit. These are also markets that are becoming more sensitive to rates and currency movements because they're looking for other intermarket dynamics to key off of for direction. And I think it's really important to contextualize this because what we're seeing is, I would say, no concern about downside, all just worried about missing upside. That sort of FOMO-driven environment. That's what we're in right now. Next up, we have CFTC overall buy-side positioning near 5-year highs. So we're, again, very long this market. Wherever we're looking, whether it's stocks, options, shares, flows, sentiment, everyone is bullish. There's no concern about downside. We've had this fantastic run. And kudos to everyone who's been playing it and been making money. That's been an excellent trade and a great investment. But at the same time, there does come a time where we have to become a little bit more concerned about those left tails that are out there that are growing fatter and fatter as the days go on. And I think that does prompt the idea that hedging or profit taking is not the worst idea to consider in the current environment. We saw what happened to SMCI. We've seen what's happened to some of the other high flyers. Even Apple looks like it's putting in a head and shoulders and rolling over. I would be a little concerned about where things are right now because we've got so much more material event risk in just a handful of stocks. And if any single one of them, NVIDIA, has a problem, that could cause a lot of reevaluation of risk appetite in other parts of these crowded trades, particularly in tech and growth. Now, when we look at the lack of broadening out, this is a chart that is a ratio chart from Bank of America, and we are at an extreme versus the equal weighted S&P when we're looking at the market cap weighted S&P. That's to say the outperformance of market cap S&P versus equal weight S&P is significant. This is not a big deal if you're not making all-time highs. It's not the best sign, but once you start grinding into all-time highs and making them and you're not seeing an expansion of the rally, it does start to look more like a blow-off top than an actual sustainable kind of expansion of a bull market environment. Now, of course, I could be completely wrong, and I'd be delighted to be wrong. I have plenty of longs. I've got a taxable investment account. I've got a retirement account. I run a long-short portfolio in my trading account. So I would be happy for it to continue. Don't get me wrong. I benefit like anyone else who's long the market. In fact, everyone is pretty much long the market one way or another. In one, sense or another, whether it's direct and through retirement stocks, whether it's indirect through real estate or having a job with a company that's raising money in the public markets, all these things interconnect. We're all kind of long in one way or the other. So I'm not trying to say that I want to see things go down because I don't, but I am saying that as someone who is a student of markets for 19 years, who's studied a lot of booms and bust cycles, this looks concerning to me. Similarly, volatility may be set to rise. The Goldman Sachs EQ Move index is implying a 5% up move with 31% probability and a 5% down move with 22% probability over the next 1 month. It's a lot more than what implied volatility is suggesting, by the way, which is about a 6% on the upside, 12% on the downside for that 5% move. So this is Goldman Sachs looking at other data, collating it and saying, you know what, we think the risk of vol expansion is actually a lot higher than what the market's pricing in, which does make different ways of exposing oneself to volatility as a potential hedge, and in a market environment where there's record short vol exposure, potentially attractive, right? Next, we have hedge fund prime book exposure via Goldman Sachs, looking at semis and semiconductor equipment net exposure versus the SOX index, which is an index of semiconductors. They are close to the most long that they've been in years of semiconductors, ahead of NVIDIA earnings. So again, yellow flag. If NVIDIA's earnings are awesome, then this is not a big deal. They can still grow their long exposure, right? But if it's not so good, you could see de-risking in NVIDIA and across the space of semiconductors, because this is crowded positioning and it's not isolated to hedge funds. The next chart we have is the share of top 5 companies by market capitalization in the S&P 500 annotated throughout history. Now, the reason that I bring up this chart is kind of similar to the reason I bring up the breadth chart. Often is the case that when this market becomes this concentrated, and right now we're at like pretty darn close to record levels of concentration. Like we have to go back to the 1960s to see things like this. Okay. That's not really the best thing, because again, you've got a handful of companies that if anything were to happen, it's like when the mobster knocks on your business's door, be like, oh, really be a shame if something were to happen to your business. Such a nice place. This is kind of like that from the risk management perspective. Boy, it'd be really a shame if something were to happen to any one of these 5 companies. That's a nice bull market you got there. It may not last if one of those foundational pegs loses its balance. So again, this is the sort of thing that we look at to say, gee, you know, it's kind of strange that there's 5 companies that make up like 26% of the S&P 500. That means every dollar you put in, 26 cents goes to just 5 companies, and the other, 495 are fighting over the rest of that 74 cents in order of market capitalization. But it also suggests that there's extremely narrow breadth, and throughout history, we can see that doesn't often resolve well for those same top 5. Now, that could happen in a number of different ways. Maybe Microsoft, Apple, Alphabet, Amazon, NVIDIA just slow their growth and other parts of the market catch up and they become less concentrated. That is a scenario that can happen. We can have a broadening out and a rotation. The other possibility is these stocks roll over and lead the market lower. When we look at the weight of information technology and communication services sectors in the S&P 500, we can see their market capitalization is outpacing earnings by a lot. And I don't know how well this will resolve. Maybe it resolves on its own. Maybe we see that earnings catch up. I think Wednesday will be a pivotal moment for at least one company in that respect. But I do think it'll be really important to see whether this gap fills with the market cap coming down, earnings coming up, or some combination of the two. I suspect that we are due for a correction in time, price, or both, with the sort of IT and tech areas, particularly the mega caps, because things have run very, very far. And again, a lot of it's been built on multiple expansion. And unless that growth starts to materialize, that becomes a concern. Now, when we look at non-dealers in U.S. Index futures, this is similar as another chart I showed earlier, but I wanted to show it going way back. This is near or close to the longest these folks have really ever been. And obviously it's in nominal terms, right? $1 billion of net length, but it's still huge positioning on the long side, which means if the market does take a bigger move lower, you got a lot of motivated sellers, some of which you have been buying at levels higher than we're at right now. Now, here's a fun one. Is this AI Abercrombie and Fitch? Look at the performance of this thing, up 377%, with a lot of that staggering rally starting in January of 2023. And it matches almost lockstep with NVIDIA. Who would have thought? And then we have Deutsches PBB. I'm not even going to attempt to pronounce the name of this bank, but their notes are falling into deeper distress because more concerns about the commercial real estate market. The Financial Times discussed this a little bit today. This decline in their note prices was exacerbated by the New York Community Bank reporting that surprise loss and dividend cut that regulators pressured them to do, the latter. And I think this is just showing that there is a lot of global concern about commercial real estate, in particular, office buildings in regions that are weak. It's not all of commercial real estate, and it's not everywhere. But office buildings, and in particular major metropolitan areas, San Francisco being one, New York being another, New York City, there's a lot of risk there. There's a lot of high vacancy. Those banks that own those debts could be in trouble. They're largely smaller banks, community banks, regional banks, some credit union exposure, not so much the major money center banks in terms of it being an outsized part of their asset portfolio. So I don't think this is going to be a crisis that brings down like Bank of America or JP Morgan or Citigroup per se. I think it's more of like we're going to see some more shotgun marriages orchestrated by regulators where you have insolvent banks where they're sold off in pieces or where they're sold at a discount to another larger acquiring bank because those smaller banks just don't have a loan book they can handle on their own. And I think that's something that'll be a theme for the rest of this year, but I don't know that that will be a big downside catalyst unless it really accelerates and becomes more disorderly. So far, regulators have done a pretty good job trying to foam the runway and mitigate the impact. Evergrande's dollar bond is worth less than 2 cents. This problem where Evergrande is going to be liquidated is part of an ongoing unraveling in the Chinese real estate developer market and local government debt market. And it's not done yet. This is why the Chinese stimulus efforts have been met with ambivalence and skepticism, because it's not big enough, and if they go too big, it's going to destroy their currency's purchasing power. Some folks would disagree and say, oh, China could use some inflation on the importation side. The problem with that line of thinking is that it doesn't necessarily make Chinese goods as affordable as one would hope because input costs are going to go up. But the other part of it is, there's two major reasons for social unrest in China. High youth unemployment, which they have, so you can check that box off. And the other is inflation. And if they get both at the same time, I think policymakers are legitimately concerned about that becoming an issue. Now, there's a good kind of inflation and there's a bad kind of inflation. Right? The good kind of inflation is when you see healthier working economy. You see rising wages. You see people spending more. That demand is creating higher prices, and it's at a gradual rate. That's healthy. That helps to grow the economy. When you start importing inflation, because, there's higher prices on energy and agriculture and otherwise, but people aren't earning more and it's more just harming the economy. I think that's what Chinese policymakers are concerned about. They've been trying to guard their currency from falling too much, but at the same time, they've been trying to ring fence this increasing risk in their real estate market. It's a perilous balance. I don't envy any of the policymakers there any more than I do the Bank of Japan, the Fed, the ECB. A lot of tightrope walking by policymakers in this situation. And when we talk about China, foreign direct investment in China has collapsed. This is not a great sign. This is down to the lowest level of growth that we've seen since 1993. Now, why does this matter? Because it shows there's just no confidence in the regime there. She has completely eroded the confidence of entrepreneurs, of entire industries, tech, education, gaming, finance, infrastructure, energy, and of investors, both foreign and domestic. Whether they're real estate investors, stock investors, you name it. And now they're coming out and saying they're going to further try to centralize technology and otherwise try to centrally plan their economy. we know that communism doesn't work. We know that communism has never worked. And we know that communism at the scale of a country the size of China is only going to inflict unnecessary suffering for their own people. And along the way, it's going to cause some harm to their economy and to the countries they do business with. This is a bit of a sign of that. Confidence is lost. Now, I'm not saying China will be uninvestable forever, but I am saying that the risks in the near term are still very elevated. Natural gas prices are close to their lowest levels in almost 30 years. That's kind of crazy, right? I renamed natural gas recently to natural crash because it just can't seem to get out of its own way. Now, I do think we're closer to a bottom here, but I'm not wanting to get speculatively bullish in this stuff. Natural gas is sort of like the altcoin of commodities. You know, you only trade it if you really, really like being sort of a degenerate high beta gambler. And I'll raise my hand. I've been in that camp, I favor now trading natural gas companies more than the stuff itself. Found that to be a more reliable, consistent trade based on the models that I work with. It used to be you could trade natural gas based on the weather forecast and based on hurricanes and based on winter. But the entire environment's changed so much over the last 15 years. Like I used to trade natural gas back in 2006, 2007. It was fun. Even through 2010, it was fun. It's not so fun anymore. And, we can kind of see by how a lot of the news of the LNG export restriction being front run by the market makes it less fun. Because there's obviously people that knew before it became public. And that was part of, I think, why it got so much de-risking. Until LNG export resumes, we still have a very high level of storage. So there's no bullish catalyst on the horizon yet. It's just, I don't want to necessarily be short it. I don't want to be long it. Just kind of sit on the sidelines, wait for something to emerge in the chart, in the bigger picture and otherwise. And the percent change in retail and food sales from the previous month. This was data that came out last week. It shows the consumer is showing some signs of slowing. We'll wait for a few more months' data before really making that assessment. But that is something we've seen from research from various banks as well. Citigroup, Bank of America, and others saying they do expect some slowing of the consumer this year. I would expect similar. I think there are reasons to believe that we could see a little bit of a hangover here. There are increasing signs of people being a little bit exhausted on their spending. So we'll just have to see what February and March's data looks like and if we see this as a trend or if this is just a blip. Now, Germany's annual house price change is just absolutely in the dumps. It's kind of perking back up, but it's still in a rate of decline that's just slowing, right? This could be the future of what we see real estate, in many different countries where things start to normalize. You could see a pretty big decline in prices once there's a bigger unlock of supply. I think that could happen eventually in the US as well. I just don't know exactly what all sets those events into motion because the Fed hiking certainly didn't do it. Everyone that had their nice, cozy 2.5%, 3% mortgages just sat on their existing home supply, didn't want to sell those homes and realize a much higher mortgage rate. So maybe it's when the Fed cuts and we see enough cutting that mortgage rates come down to the 5%, 5.5% range, that you start to see some of that supply unlock. And maybe it has a counterintuitive effect of that supply overwhelming demand and prices starting to come down until demand meets that supply. I don't know, but just speculating here, that could be what happens. It could be very counterintuitive. And so I want to thank you for watching this presentation. If you want to learn more about Macrovisor, visit www.macrovisor.com. Sign up for a free newsletter and stay tuned for exciting developments. We've got a lot of cool stuff in the works, including a whole new platform that we'll be building really soon. So this has been Markets and Mayhem with Charts of the Week from Macrovisor. Really appreciate you tuning in. If you enjoyed this, like, subscribe, share it with your friends, and I'll catch you next time.